Good morning, everybody. Hopefully you had a wonderful fallish type weekend and good weather. So we got a lot of stuff to cover today. First thing I want to make sure you looked at the 5Q tape breakdown last week is a 1-minute snippet in the manager tenure script. First 30 seconds perfect, second 30 seconds a few problems, but then does a big no-no. And guys, it's so great that we have guys that record their meetings because that allows us all, not only do they get better, but it allows us all to get better. So please, 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 it's not a huge investment of maybe 5 to 7 minutes of your time because we spend 1 minute listening and about 5 minutes learning from these little snippets. So it's about 5 to 6 minutes every other week for you to learn. So please, please, please be taking advantage of that. We have a guest speaker, one of our great advisors here talking today, and I wanted to I think it's important because some guys are gun shy about this. So first of all, give me yays or nays on this. I mean, if you were at a cocktail party and somebody said, hey, what do you do for a living? You said, hey, I'm a wealth manager, or I'm a financial advisor, or I help people with their money. Are people going to want to stick around and ask you questions about that, or are they going to bolt? So you stick around, yes or no? Yeah, no, they're not. They're going to run, right? But if instead you said, hey, I show people how to increase the income generated by their I show people how to increase their retirement income by 25% or more and reduce their chances of running out of money. Now, are they likely to stick around or ask more questions? Yeah, they're going to stick around and ask questions of that, especially if they're retired, right? And how many of your competitors are saying that? None. So that is, you have at your fingertips the best unique selling proposition I've seen in the 35 years I've been in business. So are you all using it? Heck, you know what I would do if I was in business right now? I would go to the sign store and I would have a 2 by 2 foot or a 2 by 3 foot magnetic sign made with that USP on the side of my door, both sides of my door, and on the back of my vehicle with my phone number. That's what I've been doing. So the first question we get, what Jeff and I get a lot of times was, yeah, but can we get that through compliance? Can we get that through compliance? So Tom has actually put that through compliance, and I know a lot of you have, but it just occurred to me that maybe everybody would benefit from hearing this. So I asked him, and he's been gracious enough to let us know what his compliance department said about the USP put in. Now, you didn't do the exact these two exact USPs here, Tom, but what was the exact USP you forwarded to your compliance?
Well, it is the second version there.
Okay.
On the screen. Yep.
Okay.
I show people how to increase the income generated by their current investments by 25% or more and lessen the chance of running out of money without changing their investments. And
and you submitted. All you did is submit the article we have for AGCM, right? And that proves it backwards and forwards. Yep.
With your guidance, I just attached both the Society of Actuaries article and the Journal of Financial Planning article. And I just simply asked them, is the language suitable from a compliance standpoint? And if not, how might it be reworded so that it presents that concept and be compliant? And just over an hour later, I got a response back and said, Tom, this is okay with the exception of the line that reads, I show people how to increase the income generated by their current investments. They said, this is promissory, so I need to change it. And they showed me one word to add. I show people how to potentially increase the income generated by their current investments. That was it.
And how much do you think, Tom, that's going to change people's reaction to that USP?
Nada.
They'd say, oh, potentially, forget it. I'm going to run away from you. Or do you think they'd say, well, potentially, well, am I one of those? Could you potentially do that for me?
Exactly.
How would you do that?
Opens the conversation.
So is that a huge problem? No. So guys, please, please, please be using these unique selling proposition. You know what, Jeff, thank you so much for sharing that, Tom. Jeff, I mean, how many times are we talking to people, and Missy, are you talking to people about, I need to get in front of more people?
Yeah, I'd say that's probably the thing. Yeah, that's probably at least half of the questions that I get. Like, what can I do to get in front of more people?
So guys, guess what Jeff's next question is going to be to you when you ask that question next time. And guess what my question is going to be to you next time you ask that question. Jeff, what do you think the questions I'm going to ask is?
Well, are you using the USP?
And how are you using, exactly, and how are you using the USP? Because, I mean, guys, if Tom's compliance and your compliance okays that USP, could you put it on your car? If you can't afford anything else, could you afford a $100 investment in those? And do you think that's going to generate any calls? If you really don't know how to get people in your office, pop that on the side of your car and drive around drive around places you know there's going to be people who are retired. People are going to contact you. How many people would want to know how to do this? So please, 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 make sure you're using the USP, okay? So enough on that. Thank you again, Tom, for sharing that. So if we're going to break bad news, what do we need to make sure we do? Well, this is talking about how doctors break bad news. Planning and follow-through. Discuss patient's problem list. So what are the problems? Make and explain a plan, because if you just show them there's a problem, that's not any good. They're going to say, well, thanks for showing me a problem, but you're not telling me how to fix it. No, you have to make and explain a plan, and then identify sources of support and make a contract on how you're going to follow through on that. Does this seem like a reasonable way to approach problems, guys? Not just in medicine, but with our clients as well. So discuss your client's problems, make and explain a plan to overcome the problem, identify the source of support you can use to support that them in overcoming that problem, and then make a contract. I'm going to do this if you do this. Does that seem like a good way to do it? Yeah. See, information is power, but knowledge is more powerful, because how much information do our clients get today? Way too much, which makes them think that they're experts on everything. But is the information they're getting making them more knowledgeable? No. So it's our job to what? Help them understand the information and how to use it that they're getting. Does that make sense? So when we're looking at problems, we want to look at how were problems dealt with in the past? What kind of problems, or how is it being affecting us right now, and how can we avoid those problems in the future? And I bring that up because of an article I read here a couple weeks ago. It said the U.S. is in one of the greatest bubbles in financial history. Jeremy Grantham, who has a history of getting big calls right, fears slumps in a wildly overpriced markets, including real estate in the UK. He tells Mirren, Somerset Webb, and the investors should do now. So Jeremy Grantham is a crackpot, or he has a great track record of calling bubbles? Well, today is clear, and we'll talk about that in a second. Today it is clear to me that this is one of the most dangerous package of overpriced assets we have ever seen in the U.S. Bond Guru, and this article, this wasn't Jeremy Grantham saying this, but Jim Grant saying that, is seen in the U.S. Bond Guru Jim Grant would say that we have the most overpriced fixed income market in the history of man. What have we been saying for the last 2 years? What have we been saying for the last 2 years? In the history of man, we've said that interest rates are lower than in how many years? Interest rates are lower now than in how many years? Let's see how many of you guys have been paying attention for the last few years. That's right, Nick. How many thousands, Nick? All right, Steve. For the last 5, we have a graphic. Interest rates are lower now than they've been in 5,000 years. So I guess in Jim Grant's world, 5,000 is the history of man. Well, I guess they didn't even have fixed interest prior in vehicles prior to 5,000, so we could say in the history of man. So is he correct, and have we been telling you that for the last 2 years? And hopefully you've been telling that to your clients for the last 2 years. Now, Jim Grant is some crackpot? No, he's a renowned for his erudite, witty warnings about the deadly effects of excess leverage. He's the, how do you say that? Eponymous? Jeff would know that. Newsletter's founder and editor among the eponymous, okay. Hippopotamus was among the first to raise concerns about the toxic mortgage securities swirling around Wall Street in the early aughts. Grants became popular. One major newspaper even sought to buy it. So this guy's not a crackpot. But what Jeremy Grantham is saying is that combined with an equity market that can easily lose $5 trillion to $10 trillion, depending on the magnitude of the break, is a contender for the highest price market in American history. The result could be a write-down in perceived wealth that was no precedent. Guys, if he's saying no precedent, he's including 1929. So wrote Jeremy Grantham, co-founder of the chief investor of the Boston-based asset management Grantham Mail Van Otterloo, which is GMO. So you'll see that mentioned here a few months ago. His dramatic prediction from the man is a history of getting things right. For instance, he rightly dismissed the 2003-2007 stock market rally as the greatest sucker rally in history, warned of the housing bubble in the mid-2000s, and turned positive. But he's not always a negative Nelly. He turned positive in March of 2009. So when we talk on the Money Week broadcast, listen here, this greatest bubble is one of the first things I ask him about. How big is it? And given the markets have looked expensive for a long time already, how might it end? Well, there's been a slow 12-year buildup. It's big. This has been one of the longest economic swings we've ever seen. Take out the COVID blip, a quick drawdown and up, and the long, slow buildup has gone on for 12 years. So is he including the COVID blip as a correction in the market? Because did the COVID blip really have anything to do with the market, or was it people freaking out over a worldwide pandemic? So it went down and it went up. So at the end of such a long upswing such as this, you're likely to have very substantial profit margins, and if history repeats itself, investors are likely to consider that a high profit margins will last forever. What do people think right now? They're going to last forever. That's the first part of making a bubble. Very strong economics extrapolated into the indefinite future. So is he saying that we are not seeing great economics right now? No, he's saying we are. But he's saying what? Can we have the great economics going on for 12 years and then another 12 years? No, we cannot. I mean, it just cannot happen. Alan Greenspan, former chair of the U.S. Federal Reserve, may have introduced America's aggressively pro-asset formula of cheap money and moral hazard back in the 1990s, but today, rates are the lowest in history, and we've just seen the biggest increase in money supply ever. So not only is interest rates low, they're pumping huge amounts of money into the market. Can both of those things happen forever? Because that's what's valued into the market right now. That we're going to have lower interest rates. Can we go with this low interest rates forever and ever and ever? More importantly, are they going to keep pumping money into the market? Can we afford to keep pumping money into the market? No. No. Things have been pretty stimulative outside the U.S., but in most places, this just means being at the top end of historical range. Not so in the U.S., which is broken way out in terms of both government and federal stimulus. It's the same with equity markets. Most are at merely normally high prices, but the U.S. is a candidate for the highest price market in its history. What makes this worse than the bog standard bubble is capitalism, says Grantham, particularly in the U.S., which is a little fat and happy. And are we fat and happy right now? How many people that you know think the market is fantastic and they should have all the money in the market? Hopefully not your clients, but how many of the other people you talk to? These two justices have just allowed the industry to become far more monopolistic and concentrated than ever before, the tech industry. But at the same time, companies are less aggressive than they once were. Between 1960s and 1990s, a good example of that, the latest iPhone, how big a change was that iPhone? Are they being aggressive with those changes, or are they tweaking little things here and there? Are any of these companies being aggressive like they were? No. Between 1960 and 1990s, market share was all that mattered. Now, many of the big firms focus on market share or on profit margins. Using cash flow to do buybacks, guys, have we been talking about doing buybacks and how that's been buoying the market? For example, something executives love anyway is it works well so that their stock options go up and up and up. And how much risk is there in buybacks to them? Is there more risk in trying to dominate market share by coming up with a new product? Or is it easier just to say, hey, let's buy back some of our own stock? And can they do that forever? I mean, IBM is a great example of this. IBM used to be how innovative? How innovative. And the reason I talk about IBM is they were right in Rochester, so I was pretty familiar with all of the shenanigans that were going on. They were very integrated. Yeah, they were very, very cutting edge. Dale, Bruce, Mark, yes. But then they were taken over by bean counters, and guess what they started to do? Figure out how to get new products out there, or start cutting expenses, which ended up being cutting their working staff. And it looks good for how long? Same with HP, you're right, Mark. And it looks good for how long? Until you cut all the people that were making all the innovations. And where's IBM today? How do they compare to Microsoft, Apple, Netflix, any of those? They're not even, they're a pimple on the market's behind. And that's what's happening now with all the fat, dumb, and happy big tech companies. Look at profit margin in the U.S., the rest of the world again, and see the difference. In the rest of the world, profit margins have stayed reasonably high, but in the U.S., they've crashed up, not down, they've crashed up to record highs with fairly astonishing 80% gain over the rest of the world in profits. Now, that's not a bad thing. 80% gains in profits is not a bad thing. What's his point? What's his point? The market is priced now as if there's going to be an 80% gain next year, an 8% gain in profits the next year, and 8% gains in the profits the next year. Is that going to happen, guys? When there's no innovation, there's no new internet on the marketplace right now. There's no new iPhone on the marketplace right now. There's no new streaming innovation in the market right now. Are these companies going to be able to sustain 80% profit gains? No. Even astonishing, however, is the fact that some, like 85% of this, accounted for the huge tech companies. The performance of big tech has been extraordinary. There's been literally nothing like it in history anywhere. Take Apple. The company is the biggest market value in the world. Last quarter announced that its sales had risen by 50% in the past 12 months. Give me a break, Ransom says. This is the largest company in the world. Traditionally, a brilliant year for a company of this size would be 5 to 6%. There is no precedent for this kind of expansion. One has to admit these are exceptional companies, but what's the point? If you're the biggest company in the world, and I've actually read 3 articles in the last 2 weeks saying that the people are starting to replace their iPhones more often, or not replace their iPhones more often. Not. Because keeping an iPhone for 5 years is still, the benefits you're getting is maybe a better camera. That's about it for what we use our phones for. So what's the pin? What's going to break this bubble? There's no point in looking for a pin, says Grantham. No one can tell you what the pin was in 1929. Well, I can give you a good indication what that was. We're not even certain in 2000. Again, what was the one thing that he says, not yet certain? Yeah, we're not certain, but what was the catalyst that everything went to heck in a handbag in 2000? Does anybody remember? Well, yeah, .com, but .com had been continuing since 1997. So what was the thing that popped it? What was the one thing that happened that caused, not Y2K, nope. Come on, guys, you should all know this. Man, I'm going to have to do a new coaching call on it. AOL, and how profitable was AOL in 1999? Mark's got it. AOL had never seen a profit. Had never seen a profit yet. Had not clocked a single profit in 1999 or 2000, or late 1999, 2000. Had not clocked a single profit. And they bought Time Warner. Time Warner had been profitable for how many years? 100 years. So when a company that had never seen a profit had enough capital to buy a company that had been profitable for a huge company, because Time Warner is not small, a huge company that's been profitable for 100 years, guess what people started to say at this point? This is what? Because within a few days of that merger, everybody, all the knowing money started bailing out. And once the knowing money was out, then all the suckers, the general public started saying, oh, wow, I should get out too. So is that certain? No, but after that merger occurred, and there were other mergers just like that before that, so why was that the one? That's why you can never say, and I agree with Grant, you can never tell what's going to be the actual thing that does it. But there were other non-profitable companies that had bought profitable companies. Why The AOL Time Warner was the one that finally was is enough. The straw that broke the camel's back, we don't know. But there are things that will just, at some point, people say this is enough. It's more like air leaking out of a balloon. You'd get a point where maximum confidence, maximum leverage, maximum debt. Are we there right now, guys? How much confidence is there in the market right now? How much leverage is in the market right now? Guys, what has happened over the last year? Well, how are people buying stocks right now? How's all these doughheads on Robinhood buying stocks right now? Dollar for dollar? They all think what? And leverage is great when it what? Leverage is great when it works. Yeah, I like that, Mark. Margins on unemployment money, exactly. And how much debt is there out there right now? Did you know there's more debt now in mortgages than there was in 2007 and 2008? And not a little more, but a lot more. I just got a mortgage for a house, and guess how much down payment they wanted from me? 0. Does that sound familiar? 0 down payment. Like familiar in a good way or in a scary way? So what are we to do? We don't know what's going to happen, but there are warning signs, just one warning sign or warning signs all over the place, all over sites. There are, however, warning signs. Before the great bubbles ended in 1972, 2000 in the U.S., the 3 great events of the 20th century, there was a very strange period in which, on the upside, the super risky, super speculative stocks started to underperform. Think of this in terms of confidence termites. They start with the speculative stuff and gradually work its way through the rest of the market. This time round, we are tracking that path nicely. And when he says nicely, that's not nicely in a good way. That's nicely in a bad way. It's tracking the fact that the super speculative ones are now starting to underperform. When Grantham and I spoke 4 weeks ago, the SPAC, Special Purpose Acquisition Company Index, Bitcoin tests were all substantially off their highs. Biden stimulus and the good vaccine news have pushed this bubble out longer than Grantham ever expected, as has a huge breadth of market participation. What that means is what? We now have millennials in the marketplace like they never were before, so that pushed the bubble even higher. In 2000, it also seemed as though everyone was in the market. Does it seem like everybody's in the market now, guys? So watch out for confidence termites. My favorite story, which is completely accurate, was that in the local Greasy Spoon in the financial district in Boston, there was 8 television sets on, and all of them would be showing talking heads on MSNBC and CNN, and the 8th would be showing replays of Patriots football team a year earlier. 8 out of 8 were showing Red Sox. So you got now millennials doing what? And huge amounts of millennials doing what? They were not interested in stocks, not interested in finance, not interested in anything for how long? What are they doing now? They're following the market. You see something similar today. Endless talk about Tesla sales, huge numbers of new traders in the market, all too many of them using options. Grantham reckons the termites that will have made it to the rest of the market by the end of the year. Oh dear, is there anything safe for investors, I ask? Back in 2000, there were plenty of cheap things around. Houses weren't horribly overpriced, neither was the bond market. The value of stocks were actually cheap. Grantham agrees that there is much to worry about if you're looking at the kind of things with confidence termites. The coming of the bezel, the fraud cases that appear at the end of bubbles. I won't get into this but there was a major fraud at Heinz and what's the other? Who are they merged with? Heinz. They just found a huge fraud at that. Guys, that's a ketchup company. It's a condiment company. It's a huge condiment company, but they were fraudulently cooking the books. I mean, what happens when you have household names like Heinz cooking the books? You think they're the only ones doing it? More evidence that this is about of inflation is not transitory, and in the U.S. in particular, a worsening pandemic. On the plus side, is the relative few safe havens. One place you could really find money is U.S. venture capital. Terrific. That might be great for Jeremy Grantham. Do we have any option to get into really participate in venture capital? You, me, and our clients. Yeah, Bob. Yeah, so he's saying, hey, you know what I would do? Well, with the GMO, guess what we did? We are investing in venture capital. 7% of our money is in venture capital because they don't trust Wall Street anymore. Terrific. Terrific. We don't have that option. So where do we find safe haven? What do we use for safe haven? If the market does go down, what investment do we have that would benefit from the market crashing 50%? Yeah, FIAs. FIAs automatically buy low, sell high without us having to do a single thing, without us having to call the market, without us having to get our emotions involved. So that's the kind of thing you want to be looking at. So we should be talking to our clients, first of all. Should we be letting them know? Should we be talking to our clients about how risky the market is right now? If you're a wealth manager and you're not having this discussion, what are you setting yourself up for? If you're a wealth manager and you are not having this discussion, now you're not telling your client to get out of your investments, but you're saying what? This could happen. Let's walk through why it could happen, how we're set up if it does happen, and what we should look forward to in the future if it does happen. Because is it better to be prepared for bad news or to have it hit you upside the head? If I go into the dermatologist's office thinking they're going to make, or the orthodontist's office thinking he's going to make my smile the best smile on the block, I'm all pumped up. This is going to be great. I can't wait to go in because he's going to make my smile the best one on the block. And then he says, "Oh, we got a problem. You need a root canal." That's problematic. It's better to let him for him to let me know bad news could be coming instead of saying, "Hey, everything's great," and then have them get slapped upside the head. So you want to discuss the patient's problem list. The problem list right now is what? The market is extremely overpriced. It's been going up for 12 years. That's way longer than that's way longer. That's years longer than the longest expansion in U.S. history. So we need a plan for if this happens. We need a plan if it doesn't happen. Is the 50-50 portfolio or the 60-40, 40-60, is that a plan for if it doesn't happen? If we go on for another 12 years, so 24 years of unbridled expansion, is the 50-50 a plan for that? Yeah or no? Yes. If it does happen, is the 50-50, 60-40, 40-60, is that a plan for if it does happen? Yes. So you got a plan, don't panic. Let's talk about this now. Let's talk about this now. Show them how the markets can go down. How many people have forgotten this? How many people have forgotten this? See, because what they're being told is what? They're saying, hey, above averages, above are all the stock market crashes in the past 100 years. If you're scared about the bear market, remember, it has to come back before, and it always comes back. Guys, I agree. Have I ever told you the market is a bad place to be? Have I ever told you that the market doesn't come back? No, it does come back. But do we work with the general population or do we work with retirees? So when the market comes back, what if you became retirement and it took 18 years to get back? What if you're halfway through retirement and it takes 18 years to get back? What if you're at retirement here, it takes 25 years to get? What if you're only halfway through retirement and it takes 12 and a half years? How about 17 years? You're only halfway. It takes 9 years. Guys, can our clients weather these? And what would happen, think about this. What would happen if I sat down with your clients and showed them this one particular graph? How many of them would be freaked out? How many of your competitors are showing their clients this graph? And should you show them this graph? Yes. Yes, yes, yes. And none of your competitors are showing it to them. So what caused these crashes? Well, on September 29th, the London Exchange crashed when Clarence Hatry was jailed for fraud. They're like, oh, how much other fraud is going on? Boom. 1974, the collapse of the Bretton Woods system. 1987, Iran fired missiles at the two U.S. flagships. Boom. Now, there was a lot of stuff going on, a lot of warning signs here. A lot of warning signs here. A lot of warning signs here. 2000 AOL, no profits by time. A lot of warning signs before this happened. It's just these were the straw that broke the camel's back. The bankruptcy of Lehman was the final straw that broke the camel. There was a lot of problems before 2008, but that's what caused it. 2018 February, two small funds shorting volatility broke up. So there was warning signs, and these were the straws that broke the camel back. COVID-19. So we never know what's going to be the catalyst, and should we ever try to time that? No. Talk about it now before it happens. J.P. Morgan, I made a fortune by getting out too soon. Bernard Baruch, I made my money by selling too soon. And remember, we've talked about this. Timing your move into FIAs. On one side, we'll place $100,000 in S&P 5 index, reinvested dividends, and no fees of any kind. On the other side, we'll place $100,000 at fixed index annuity that credits interest-based on the S&P 500 with caps at 5%. Well, let's look at this. Crash of 2008. What would happen if you just left your money in? What would happen if you left your money in? Well, let's look at that. Let's say you got out too early and switched FIA to the end at the end of 2006. Well, you got out too early. And what happened? Boom, boom. You ended up with $114,000 and getting out 2 years too early. Where the S&P 5 index is at 98. You think your clients would rather have 114 or 98? By getting out too early, would they rather have 114 or 98? And did they have any of the heartbreak through this? No. Okay, what about people that got out in 2005, 3 years too early? Okay, well, 119 versus 111. Would they rather have 119 or 111? What if they got out the exact perfect time, 2007, 115 versus 108? Where's the biggest difference here in benefits? Getting out right at the right time or getting out early? What's the biggest difference? Biggest difference is getting out way more than early. Yeah. Same thing with 2000 crash. Same thing with the 2000 crash. So getting out 2 or 3 years early is not a bad thing. Getting out 1 year early is not a bad thing. And we all know we can't get out at the exact right time, but it does not matter. Getting out early is the right thing to do. And again, what are the wealthiest people in history? J.P. Morgan, Bernard Baruch, they both said they made money by timing the market perfectly or getting out early. So please, guys, if you have not talked to your clients about it, if you have not balanced your clients' portfolios, you need to be doing it now. I won't have another market call here, talk about the market for the next 2 or 3 weeks. But why do I keep bringing this up? Why do I keep bringing the market is dangerous now? For the last 2 years, I've been bringing this up. Why? So that you guys, not for you guys know. You guys know. But I don't think many of you guys know you should be talking to your clients about it. I think you know, but you don't know that you need to be talking to your clients about it. You need to be talking to your clients about this, okay? You have to. Okay? Super. Well, you guys have a wonderful rest of the weekend. We'll talk to you all next Monday. Thanks, everybody.